And so if you want to talk about building wealth, it's not going to be putting it into a savings account. Saving only gets you so far.
There's going to be some times that it's down, and there's going to be some years that it's really far up. You just have to stay the course and know that there's going to be that average, right?
Investing doesn't need to be as complicated as people think it is. For the majority of people, keeping it simple is actually better.
If you are going to be the person that jumps out at the very bottom, like, I don't know what to tell you, but that's not the move there. You just have to let it go through.
Welcome back to the show. Lauren and I are back for our weekly episode where we talk all things money. Lauren, I found this video online of this guy. He was going around asking people for their best finance advice. So let me play it for you. I want to get your opinion on it.
What's the best finance advice you've ever got?
Save $20 a day. 20 a day times 365, 7,003. A year times 2 years, 14,006. 3 years, 21,009. 10 years, 73,000. Compound interest, 78 grand. Save 20 a day, and you always keep broke away. The reason why people don't have money is not how much money you get paid, it's how much money you save. I know people who work McDonald's minimum wage, and they make more money than people make $40 an hour because they understand where they at. So they save trying to get hired. And then the people who make more money, they spend more money, and they get more habits. You know what I mean?
Yeah.
Hey, good luck, good life. You know what I mean?
Yeah.
But you gotta save money. Without saving money, you got nothing to invest. That makes sense?
Yeah. That was some good advice.
What'd you think of that, Lauren?
Yeah, I like what he's saying there. I think the biggest takeaway is creating the habit of saving. Even when you are making a little bit of money, because we've both seen it, as you continue to increase your income, it seems like your lifestyle also goes along with that. And then you suddenly feel like, I don't have any money to be investing or saving. And you're like, this is the most I've ever made in my entire life. Why do I feel that way? I like the sentiment there, saving, creating that habit. I think we could touch on a little bit on investing, but I do like the overall sentiment there.
Yeah, I think he said a few really good things. First, $20 a day keeps the broke away. I like how he said that. But the second, it matters less how much money you make and more how you spend that money. If you are on a limited income, but you are very, very disciplined with how you spend your money, it can go a lot further than someone who has a higher income who just spends how they want to, exactly like what you're saying. But then that last thing he threw in right at the very end of the video is if you don't save, you will never have money to invest. And I think that's the really important thing there, because he was talking about $20 a day, 365, that was, I think he said $14,000 or $15,000. And then he just kept adding that same number, $20 a day. And I think it's kind of missing one fundamental truth. And that's, you can't save your way to wealth. It's one of those cheesy lines that I think everyone's heard when it comes to investing is and I believe it's so true too. You can't save your way to wealth. Saving only gets you so far. At some point though, you're missing out on so much. Your time is not being used to the best of advantage that it can be if you are not investing that money as well. Yeah,
for sure. But I feel we're not really, we can talk about it, but I think people get too much into the deep details about investing. So it scares people. And then they're like, okay, well, I'm just going to keep this money safe in my bank account, in my savings account, so I can access it whenever, because I don't want to put it in the stock market and lose it all. You know what I mean? So I feel like breaking it down for people to easily understand is something that more people need to hear, because otherwise you're going to think, the stock market's bad, I'm just going to save my money here and have only, what is that, $20 per day that he was saying. Yeah. When really, if you put it in the market and let it go for 30 years or something, you're going to have way more than you ever could by just saving it in a savings account.
100%. And those are the two most common things I hear when I talk to people about investing or really taking control of their money. It's that they want to keep their money safe, and that's a reason for not investing, or that they just don't know enough information. And, before I really started taking my finances seriously, I kind of fell into that second category where it was I just didn't have enough information about investing to even ask the right questions. And I remember specifically, I was in line somewhere and I was waiting. I can't remember exactly what I was in line for, but I was in line for an hour, and I just happened to be talking to the guy next to me, and he was, I don't know if he was a CFP or a stockbroker or something, but he helped people with their portfolios and investing. And I remember just some of the, thinking back on it, some of the questions I asked him, I was those just weren't even the right kinds of questions to be asking to get started with investing. Trying to ask him what stocks do I, should I buy? What are the right stocks for someone who's just getting started? Questions that when you start to have a little bit more information about it, don't really make sense. that's not where you want this starting point of your investing journey to be. But I think today is the perfect opportunity to talk about that investing doesn't need to be as complicated as people think it is. I think for the majority of people, keeping it simple is actually better. Just like that's true with a lot of your finances as well.
Yeah, for sure. And I feel like whenever I was in my 20s, I think I had mentioned before that I worked at a job. I was there for like almost 7 years, and it was a university job, so like an education. So I had a pension there. So I never felt like I really needed to understand investing because it was a mandatory, like they had to take a chunk of my pay and put it in the pension. I didn't really have a choice around the matter, and I was only making like, oh my gosh, I think my salary was like 30,000. So like I didn't have money outside of that to be investing. So I didn't really know anything about it because it was just kind of like, they're going to do their thing. They're taking it out of my account. They're investing it however they want. So I didn't really have to have an understanding of it. So I didn't really learn more about that until after my debt-free journey was over. And then I started investing more heavily once I understood it. And at that time I was a contractor and had to kind of figure it out for myself because I had a 401k, but they weren't matching or anything through the contracting agency I was working with. So I started some investments on the side to really bump that up. But I think we could start today by just kind of like asking the question, what is investing? Like kind of break it down in simple terms for people that they can actually understand. So Nick, why don't you walk us through what that looks like?
Yeah, I think when people hear the word investing, they think of like all those movies like The Wolf of Wall Street or The Big Short, things like that, where those movies can get complicated when they really get into it. In the simplest terms, when you're investing, you're buying a portion of a company or a group of companies. And the hope is that by buying into that company, you now become an owner, and that company will grow, right? That company will be more successful. They'll earn more money. And then in turn, what you put in starts to grow as well. As simple as terms, it's putting your money to work for you so that hopefully over time it starts to grow. And I think, that's the important part there, is because the things that your money can do in the stock market are so different than what they can do in just a traditional savings account, right? Like in a traditional savings account, especially if it's at like a big bank, you're getting like 0.1% or something. Like I have some money in like my Chase savings account, and like it gets pennies every single month, and a high yield savings account is a little bit better because you can get like 2 to 4% interest rate there. But in the stock market, if you're in, and we can kind of talk about some simple investments, but like you can expect on average like 8 to 10% a year, and you just can't beat that if you aren't investing. So yeah, in simple terms, it's just buying into a company with the hope that company is going to grow and you get some return on that.
Yeah, and I think we hear so much in the news like, people are losing their money in the stock market, and or we always think about like day traders who are putting money on one single stock. So I think it really freaks people out because they feel like, investing in one single stock is going to be super risky, which it is. And that's actually why I don't do that. I do more of the index fund approach where I'm actually, purchasing like a bundle of stocks instead of, that one single investment. There's people out there who have probably invested in single stocks and have, maybe Amazon back in the day, and they're multimillionaires now. That's great. But I just don't have the personal knowledge around which single stock investments would be good. So I think that's where a lot of people get afraid, is because they really feel like there's no other option besides like picking the single stock and hoping it's for the best, and I'm probably going to lose my money. You know what I mean?
Yeah, and I don't have the exact numbers, but I remember there was a study that came out that talked about how the majority of day trader investors, they didn't beat the S&P 500, which for those who aren't familiar, the S&P 500, it tracks the top 500 companies, 500 or so companies in the US. So investing in a fund that tracks S&P 500, you're basically investing in those 500 companies. And these are some of the largest companies in the world, but primarily in the US, like Apple, Microsoft, Tesla, things like that. And the study said that the majority of people who pick individual stocks as opposed to picking a basket of stocks, like they don't beat out on it. And I know, like you said, I'm not going to spend the time to be researching all these companies. Like sure, hindsight's 2020, right? You can see like, I should have invested in Amazon, 20 years ago when it was just some guy selling books out of his garage, right? Like that it's hard to look at that into the future and try to predict. And so I'm in the same boat. I do have some individual stocks, but for the most part, like I would say 90+% of my investments are just in mutual funds or index funds, things that track broad markets that like the hope is that I'm not putting all my money into one one basket or one egg, right? I'm putting it into a basket of eggs. And there's these markets are so large that in order for those to fall or for me to lose money there, so many other things have to be going wrong where I'm probably not going to be worried about what my portfolio is doing anyway,
Yeah, for sure. Now, to kind of describe the difference between like what is the difference between saving and investing? Like, why do people actually need to be investing, and why can't they just save their way to retirement? Talk us through what that looks like.
Yeah, I mean, like I said, it's one of the truths that you'll hear about investing is you can't save your way to wealth. I think the problem with saving is that there's very little inherent value to the people who are giving you money for you to put your money in with it, right? Like and it's so true. Like with greater risk typically can come greater reward. When you're saving, it's even like if you're in a high yield savings account, right? Like I have my high yield savings account through Vanguard. Another one could be like SoFi or Capital One has like a great high yield savings account. You're just giving that bank your money for them to then use to do whatever banks do with it, right? A lot of times they'll put it into their own investments and they'll give you a piece of that, right? But there's not a whole lot of risk there, as opposed to if you're putting it into a company, the company can fail, right? Like that's how you see people lose money in the stock market is they bet on companies that aren't good picks. But the problem is if you're just putting it into a savings account, you're getting on the low end, like next to nothing. And on the high end, I mean, when we were at super high interest rates, it was like 4.5%, and 4.5% of growth over the course of 30, 40 years, you can't beat what you could get into the stock market if you were looking between 8 and 10%, right? Which I had mentioned it before, the S&P 500, I want to say it's averaged like 10% over the last 20 or 30 years, which you just can't beat that into a savings account. And so if you want to talk about building wealth, it's really what's going to be my best path forward. It's not going to be putting it into a savings account. And if we were to run some math, like you can see the difference between what 3 or 4% gets you versus the difference between what 7, 8, 9% can get you. We're talking hundreds of thousands of dollars over the course of 10, 20, 30 years. In some cases, depending on how much, it could be over $1 million difference,
Oh yeah, for sure. And you can look up the graphs out there, like even pull up the S&P 500 and see how much it's gone up over the years. Now, like you said, I think the average rate of return is between it's like 10 or 11% or something like that. Yeah. But there's going to be some times that it's down, and there's going to be some years that it's really far up. You just have to stay the course and know that there's going to be that average right in there. So people need to understand that. But yeah, that is the way to really gain wealth by not, you can't just do it within a bank account or a savings account. Yeah. You're going to have to invest in those companies. And I think the thing to note here is, I do a lot of, mostly everything I have is in the S&P 500 at this point, just because I'm so young and I'm not retiring anytime soon. So for me though, that feels comfortable because, in those 500 companies, if one starts to fail or do bad, they're going to replace it with another one. You know what I mean? So that's the top 500. So we're all, and we're not doing single stocks. So it's not going to go down completely. And, to say that the stock market might crash and, it's going to go to zero would be absolutely crazy. I think we're running into more issues than that. If that were to happen, that would mean that all companies are worth zero. We would not have an economy as we would know it. So I think that that's a little, unrealistic to think about. But that's where I stand with it. I've sort of just, trust that, S&P 500 is kind of where I like to go, but I don't know. What about you, Nick?
Yeah, what you had said that with the S&P 500, if one company starts to do bad, and even like we're talking, there is tens of thousands of companies in the US. And so for one company to do slightly worse doesn't mean it's necessarily doing bad. It's just other companies might start to do better, but they'll automatically rotate out those companies every so often so that the top 500 companies are inside of that fund and you're investing in the top companies. And a recent event that happened, that you might have, Lauren, you might have seen this online where like that, I think it was like a Coldplay concert, that CEO.
Oh my God.
Did you see that? Yeah. He got caught like cheating with his HR manager or having an affair or something. And he was on like the kiss cam or whatever. And he just like ducked out. I'm like, those are types of events that can happen to where if you're betting on a single company or even a group of single companies, right? You pick your 10 favorite single companies. Things like that are what could cause the stock to dive. Or someone, they release a report that is a little bit less than favorable, and that causes the stock to dive. Like you are putting so much faith in just a handful of people who are controlling a company, as opposed to if you are in the S&P 500 or you're in the total stock market index fund, we're talking between hundreds and thousands of companies, which then, you can kind of expand that hundreds, tens of thousands of people who are supporting the growth of those companies, you know? So it's just looking at it from that point of view. But yeah, I'm the same way as well. Like I said, 90+% of my investments are in the S&P 500. I do have like a couple individual stocks that I had picked when I was like first starting to invest. And let me tell you, most of the individual stocks I picked when I first started did bad, and I sold those a long time ago. There was like maybe like 2 out of those 10 that I had picked when I first started that did, you know, well enough that I ended up keeping them. And I still don't really invest in them anymore. I'm holding on to them because I'm hoping that they'll continue to do better. But that's a risk you have to play if you don't want to pick a fund that's going to track several companies at once.
Yeah. So it's not that scary. We don't have to be doing individual stocks. You can do a bunch of different companies at once. And honestly, it's super easy to get into like an S&P 500 fund. If you have like your Roth IRA, your IRA, whatever, through like, Fidelity, Vanguard, or wherever you have it, it's super easy to just Google what is the S&P 500 fund here, and then you can go invest your money in that. Super easy. But let's talk through a few of like common investing terms that people hear and they either get scared or just like, I don't know anything about that. We sort of touched base on it already, but let's sort of walk through some of these. So let's touch on stocks, and people always hear stocks, bonds, index funds. Can you sort of talk through each of those and what are the difference between them?
Yeah, and so we kind of talked about what a stock is, and just to recap, like you were buying a small fraction of a company, and so the stockholders, like you are buying a small portion of that company, and when that company does well, you as a partial owner, which is kind of funny to think about, if you buy Apple stock, you're a partial owner of Apple. Now, one share out of the millions that they have out there, you know, you're 1/1,000,000th of an owner, but yeah, you buy a small fraction of that company, and then as that company does well, you also will get some of that return. Now, a bond is kind of similar, but typically when you hear bonds, like you can think of like U.S. backed bonds, and that's you lending money to the U.S. government. You purchase a bond, and it's basically like an IOU. They're going to give you back that money. A lot of the times, the way that they structure them is that it has a guaranteed return. Sometimes I bonds or T bonds, they'll have guaranteed returns with them. Otherwise, you can just buy into like the bond market is another one which tracks several different markets of bonds, whether it's U.S. or international bonds. Now, index funds, we talked about what a single stock is. An index fund is basically a fund that tracks an index. And so an index could be the S&P 500, the top 500 companies in the US. There can also be a technology fund, which tracks some of the top in the technology sector or the energy sector, or pharmaceutical companies. You could buy something like a total stock market index fund, which is going to track like 3,000 to 4,000 different companies across the US, small and large. And so an index fund is basically just a bundle of stocks. You can think of it as like, you know, Easter time, you have your basket full of eggs. That's basically what an index fund is.
Yeah. And I feel like whenever I hear mostly things about bonds, we just touched on that, I often hear that for people who are getting closer to retirement because the return is not as great. Can you touch on that a little bit?
Yeah. So the thing with bonds is that the return isn't as high, but it is more predictable and stable. So in other words, it's less volatile. And when you look at a stock chart, you can see like if you see like high peaks and low valleys at the bottom, and it's going up and down, that's called volatility. That measures how the up and down of the stock market, if you will. Now, a bond has less of that because for a lot of bonds, they have a guaranteed return. And so it's a bit more stable. And so typically, if you are younger, they say you can take on more risk because you have time for that risk to average out. You know, like Lauren, like you had said, the S&P 500 averages 10% per year, 10 to 11%. Well, that includes years where it was 15 to 20% positive return. And then it includes years where it was flat or where it was like 1%, you know, or years where it shrunk completely. Like we saw like during COVID, for example, it dropped like a ton. The 2008 stock market crash. The thing with a bond is that as you get closer to retirement, you want a little bit more stability. You don't want as much fluctuation in what your retirement account says because you want to be able to sell when you need the cash, not have to wait for the market to be at the all-time high, right? So that's kind of the benefit of bonds. And so, you know, I think there's an argument to say that if you're a young investor, you could have a small percentage. Like I know for me personally, I have 5% of my portfolio in bonds. I have 10% to 15% in international. The rest of it is heavily focused on S&P 500 because that's also the market that I believe in. But as I get older, those percentages are going to start to shift closer to more stable investments. So that way my portfolio is steadily growing as opposed to having heavier swings.
Yeah, I have I have a target date fund that I've been putting into just to kind of see what it looks like. But so it'll get more conservative as I get older. I think mine's like 2055. So as I'm getting closer to retirement, it'll start to shift into some more conservative investments. But moving on here, so people again, we're hearing so many investing terms that I think it just gets so overwhelming for people. But what do you mean? What do they mean when they say diversification, or what is your risk tolerance? Can you talk us through what that looks like?
Yeah, I think diversification and risk tolerance are very closely linked. And so diversification, I mean, you can think about how different are the things that you're investing in. If everything is the same, and you can think of that in very small terms, like if you have like zero diversification, you have all your money in one stock, right? And it might be like your company's stock, which you're able to buy into. And so all of your retirement portfolio is inside of one stock. That's very low diversification versus very high diversification. You might track a total world index fund, which tracks companies, thousands of companies across the entire world, not just the US, not just Europe, but everywhere. That would be highly diversified. The benefits to having high diversification is that if one sector starts to do bad, the other sectors are there to kind of pick up the slack. For example, if for whatever reason, like the tech sector, the tech companies start to do bad because maybe there's not as much development, maybe AI was not the route that we were supposed to be going down, or whatever it is, right? Or there's government intervention and now they can't even use AI anymore. There's so many different ways that can happen. Well, if you're highly diversified, not all your money is going to be in the tech sector. And so now the energy sector or the pharmaceutical sector or the medical sector, those areas are going to kind of lift that up for you. Versus if you have all your money into a tech company and then that company crashes, like you're kind of screwed there. And risk tolerance is a very similar conversation as well, because typically higher diversification, you have lower risk. Now, risk tolerance is also going to be your personal tolerance to that risk. And so that's kind of what we had talked about already, where it's like, if you're younger, you can have a higher risk tolerance because you have more years for those averages, or for the highs and lows to average out into a positive growth, consistent positive growth. A low risk tolerance, though, you're probably going to want to be in something like something safe, like a total world or a total US, or, some people even consider the S&P 500 to be risky because it only tracks the US, so risk tolerance is a personal measure, but your level of risk, you can kind of gauge with how diversified or not you are.
Yeah, for sure. And I was thinking, whenever you're talking about diversification, I think about people who kind of put all of everything they have into real estate, whether that's, rental real estate, whatever. But I think about times like COVID. If you had all of everything you had was in, rental real estate or whatever, there was probably a period of time you were a little bit nervous because people were getting laid off, probably not able to pay rent. I know that some people were dealing with that as far as that goes, but so I think that's why it's super important to, if you want to have rental real estate, that's great. But also, having some money, maybe put in the market or whatever, just making sure that's diversified. So even across, different types of stocks and index funds and things like that, but outside of that as well, if
different types of investments.
Yes, exactly.
That makes total sense.
Yeah. Now, last kind of term here that I think we understand what it is, but maybe couldn't fully, explain it if we had to. But what is compounding interest?
I think the easiest way to think about compounding interest is to kind of try to visualize it. And so to take everyone back to like, what would it be, geometry or
don't ask me about math.
Just think whatever math class you want to think of that you hated. When you think of linear growth, right? You have a chart and it just kind of looks like an L, right? Linear growth means that the chart is consistently going in one direction upwards, right? Up and to the right in a straight line, you could think. That's what linear looks like. For every block that it goes to the right, it raises one block as well, right? So it's a linear straight line growth. When you think of compound interest, you start to think of a line that starts off relatively flat, and then as time goes on, it picks up speed, and then it starts to just skyrocket. That's how I like to think about the difference between linear and compound growth is linear is going to move in a straight line. So as time goes, like more time isn't going to be better, right? It's going to be the same rate of growth over time. Compound, over time, your rate of growth is going to increase. And so you can also think of it like this, 10% of $100 is $10, right? Mm-hmm. But 10% of $1,000 is $100. And then you start talking 10% of $100,000. It's that same 10%, but now we're talking about $10,000, right? So that same percentage starts to get larger and larger as the whole pie gets larger, your piece of it starts to grow as well. Yeah.
So for investing, compounding interest is great. But if you're talking about credit card debt, compounding interest is not great.
Yeah, absolutely. It's the rate of growth of that, the balance of that. And so if that's debt, that's growing, in the negative for you, but if it's investments, that's growing in the positive for you.
Yeah. All right. Well, let's move on here. So, how do people actually start investing when they're kind of feeling uncertain about it? Like, how do they go about it?
Yeah, I think like a pre-step, and there's probably a few pre-steps to this, but I would say like just to generalize it is to have your financial life in order. And so what do I mean by that is you've paid off like your high interest debt, right? Like I personally, like I'm out of the belief that you should be investing if you have like high interest credit card debt, right? Like unless you are like a genius picking stocks, like you're not going to beat the 20 to 30% of high interest credit card debt. So the best return on investment you can get is going to be paying off those credit cards, right? Yeah. So you've paid off your credit card debt. Now the next step for me would be you've built up an emergency fund. You've kind of gotten your financial life stable now. You can accurately budget, and that can be, a loose term. It doesn't have to be exactly like how I like to budget, but you at least know how to manage what's coming in and what's going out on a monthly basis. The reason I say that is because you don't ever want to put money into the stock market that you have to have access to, right? Money that you can't afford to lose. That's kind of one of the golden rules when it comes to investing, is that this is money that you can afford to put away for the future. Hopefully it will grow, but if you lose it, you're not sacrificing your ability to pay for rent or to buy groceries or things like that. And then you also want to be able to understand how your money flows in and out on a monthly basis, because investing really works if you can do it for a long period of time and you can do it consistently. And so if you don't really know how much money you have to play with on a monthly basis, 1 month you might invest $100 and then you might invest $500 and the next month you invest nothing. Like the growth that you're going to see is going to be very spotty, very inconsistent. What would be better is if, all right, I can commit to investing $250 a month over the next, for the next year, and then maybe I'll reassess to see if I can start doing more. So what I would say is for people to get started, get yourself to a really stable financial position and figure out how much you can actually start investing with. I think that's a really good place. What do you think?
Oh yeah, for sure. And I think, I'm sure probably a lot of people are investing like I was doing, back at my old job, putting something into a pension or a 401k, whatever your workplace offers you, depending on what type it is. But I think a lot of people are probably already doing something there, but maybe even diving into that a little bit deeper to find out, where is that 401k going? What am I being invested into? I just set up a new one for the new job that I have. And essentially I just went in and picked, I think it was also through Fidelity. So I just picked like an S&P 500. So that's where my 401k is going. Yeah. But I would say a lot of people, just to start, obviously get your financial health in order, but then just dive into what you already have. A lot of people probably already have something through the workplace. See how much you're putting in there. See where it's actually going inside the 401k. Typically a lot of them, you can kind of do, they'll assess your risk tolerance that we just talked about and see what kind of vehicle you want to put it in. You know what I mean? Like in the 401k, in an S&P 500, or they'll have some more conservative options and bonds options, whatever. Yeah. But even diving into that first could be a good thing, just to learn a little bit more about, wow, I am investing and where's it actually going, Yeah.
I think that's a really good point, because I think, like you said, most people are going to have access to an employer-sponsored retirement plan. And so they're already going to be investing. And a lot of people don't even consider their 401k like they are investing. For a lot of people, it's like, well, that's kind of the only thing I'm doing. I'm not really investing my money outside of that. But I think a really strong starting point as well, like I said, once your financial life is in order, you can kind of figure out how much you can afford to invest. I think looking at the goal behind this investment is also a really good starting place as well. And typically when people say, I want to start investing my money, that's the first question I ask, like, why? Is this for retirement? Is this because you want to save up to buy a home in the next 5 to 10 years? Typically, if you can find an answer to why you want to be investing, like what's the purpose of that money, that's going to tell you where you should park it. In other words, like, is this going to be inside of a retirement account, a taxable brokerage account? Like, when do you need access to this money? And it's also going to tell you what type of investments might be safer for you to do. I think if you can kind of figure out where you want your money, what the purpose of your money is, that's going to help you pick where to put it in. And then that's also going to help you pick what type of investments. If you're talking about retirement investing, and that's going to be a 20 to 40 year goal, then it's really, to your benefit to open a retirement account like a Roth IRA or a traditional IRA, and to pick something like an S&P 500 or a total stock market or even a total world index fund. And that's going to allow your money to grow consistently over time. Versus if you're saving up for a house that you want to buy in 3 years, well, maybe your best investment vehicle is not going to be in the stock market. It's going to be a high yield savings account. So that's a great place to start as well, is figuring out what the purpose is of that money.
Yeah, for sure. And for myself, I know that I don't want to work forever. I really don't want to work. I really don't want to work until 60. I just can't do it. I'm not a working girl. I don't like it. But for me, I have the 401ks from the different jobs that I've had. So I am actively investing in there. I'm also doing a Roth IRA, but I also have a brokerage account, and we're going to talk about what all of these mean. But my brokerage account is something that I'm going to be able to access before I'm 59 and a half. It is an investment account, but it's not tied to retirement, or it doesn't have any age restrictions or anything like that. So that's kind of my sort of approach to it, because I've assessed my goals. Do I want to work forever? No. So that's kind of what I'm doing there. But talk about, when people are hearing like, oh, they're 401k, we understand really what that is, employer sponsored retirement plan. But talk about like the Roth IRA. That's the hot thing, of course. But also talk about the brokerage account. Like, what are the difference between those? What should people have? Bare minimum, what should they start with?
Yeah, I think the Roth IRA is probably the best place for most people to start with if they want to get into retirement investing. And it's literally in the name. It's an individual retirement account. Now, the difference between a Roth and a traditional is basically just how it's taxed. They're both kind of taxed very similarly. It's just, do you either pay taxes now or you pay taxes later? So if you want to pay taxes now when you know the tax rate, and then your money grows tax-free, you can put that into a Roth. If you want to pay taxes later, and in other words, you have more, a lot of people like to think of it as, well, now I have more money to invest because that money isn't being taxed. Then you can put that in a traditional. It'll grow with all that money, and then you just pay taxes as you take it out later. I think I personally always lean towards a Roth IRA because I know what taxes are today. I'm comfortable paying those, so I'd rather pay those instead of what they may be in the future. Either way, though, like, you can get into a Roth IRA. I think that's the best place for most people to start because you have access to the entire stock market in terms of what you can pick. For a lot of people inside of their 401k, they tend to be limited, right? They might have like a handful of options that are going to be based on their risk tolerance, or it might just be into a target date fund like you had mentioned. Now, that's on one end, right? That's if you want to get started with retirement investing. If you're not sure the purpose of this money and you're like, I just want to start investing, but I don't know if I want to have access to this sooner or later, then that's when it would be best to go into something like a taxable brokerage account. Taxable meaning that no matter, you're going to pay taxes on the money, obviously, that you have. You put that money into it, and then you pay taxes as you go and sell it, assuming it's grown. The nice thing about that, though, is that you can access that money at any point in time, whether it's gone up or it's gone down, whether it's been a month or it's been 10 years, you can access that money. And that's what you were talking about right now. A bridge account is what a lot of people tend to call it, to where I'm going to invest inside of this account because I want to have access to it in the next maybe 5 or 10 years, as opposed to a retirement account. You have to wait until you're of retirement age to access. And personally, like, I think as you kind of get to those higher levels in your personal finance journey, having multiple types of accounts that are going to serve the different purposes behind your money, I think is really important.
Yeah. So we learned about like the different investment vehicles. We've talked about like what stocks are, what index funds are. So we have like the overall, okay, we need to pick the vehicle. Do we want to do an IRA? We can go to Fidelity or Vanguard and open an account there. Pretty simple, right? Then we need to pick if we want to do an S&P 500 fund, if we want to do a single stock. I don't recommend that right away. But if you want to do something like an S&P, then we can go in there, invest our money, and put it inside that fund. You've just invested. There you go. Set it and forget it. So I think something that's important here is, and kind of what that guy talked about at the beginning in the video, is like a consistent amount, like creating that habit. So I think a good way to do that would be to create like an automation with that, something that's going directly out of your account into that account, something set it and forget it, so that you don't, that money doesn't walk away and go other places. It's actually going to be invested. So I think that's an important thing to remember as well. Now, Nick, is there anything else you would suggest as far as how do people get started with it, or what to pick, or anything like that?
I would say like a few of, and we've kind of talked about some of these, but I would say a few of like the golden rules before you start investing. It's really important that you understand that these things is that, one, I had said, don't invest money that you can't afford to lose. And what I mean by afford to lose is you're investing money in place of paying for an essential that you need today. If, obviously no one likes to lose $5,000, but if your financial life, like if your life wouldn't change, in other words, like you're not sacrificing your housing or your food or whatever, you could have, technically afford to lose that money. So don't invest any money that you can't afford to lose. I would say the second one is not to invest in something that you don't understand. And a good rule of thumb is, could you explain this to like your 70-year-old grandma? And if you can, awesome, then it's probably something that you understand well enough. Or could you explain it to a little kid in very simple terms? I think that's a really important one. Like, don't just take our word for it. Don't just take any random stranger's word for it. Understand the things that you're investing in. Be able to have a base level of understanding of how it works. That way you feel confident in it. And then the third is that consistency is really key, like you had said. Investments, when I think of investments, it's a long-term game that I am consistently investing in for time to do its magic. Compound interest really happens when you give it enough time to start working. Those are the three things I would say are the most important if you want to start investing. Beyond that though, like, start simple and then work your way up into the higher levels of complexity with investing. Yeah,
for sure. And I like what you said about not investing in things that you don't understand. Google is such an amazing tool. You can literally Google any type. I do it all the time. If I'm looking at like a new fund I might want to put my money in, I just go ahead and Google it and kind of see what the returns have looked like over the years, and just kind of get a good sense from that. You can look at data will show you everything. So I think that's a really good place to start before you just start, investing in things that maybe you don't fully understand. I think another good question, and we hear this all the time, but we talk about like when the stock market crashes and people are saying, I lost all this money, blah, blah, blah. How do you answer the question, what if I lose all my money, or is this super risky? Like, how can you help somebody feel confident about investing their money?
So like I had mentioned in my financial journey where I started, I was a really big Dave Ramsey fan when I first got into personal finances. And one of my favorite sayings of his is that the only people who get hurt on a roller coaster are the people who jump off in the middle of it. And that's the best way to think about investing in the stock market is if you are right in the middle of a huge downturn in the market, you're only going to lose money. You're only going to get hurt on that roller coaster if you sell, right? Now they're selling to minimize your losses, and that particularly might happen if you're invested in a single stock. And then they're selling because you read the headlines, you watch too much news, like you listen to people who don't really know what they're talking about. And then that's when you really lose money, and you're getting hurt in the middle of that roller coaster. I would say the real truth is you don't lock in your gains or losses until you sell. And so right now, if I look at my portfolio is up right now, right? The stock market's doing very well after a few months of doing really bad. Everyone feels like a genius right now. I haven't actually made any money, right? I haven't made any money unless I go and sell that. And I'm probably not going to sell it because I believe in the next 5, 10, 15 years, that market's going to go even higher, But same thing when the market was down, 3 or 4 months ago, I didn't actually lose any money. It wasn't fun to look inside of my retirement accounts and see them down like $10,000 or whatever. But I was able to see like, all right, I haven't actually lost money until I go and sell this. And so that's a really big thing is like, don't just listen to the headlines. Don't listen to like people who are saying the market's going to be down for the next 5 years. No one knows what's going to happen. Literally, we're at a point in time where like little changes or things that people say can make the stock market go up or down like crazy. You just got to understand that you don't lose money until you sell. You don't gain money until you sell either, though.
Yeah, I was just going to say, a few months ago when tariffs were in the news and whatever, the market really did dip and it was scary. Yeah. I will say, I looked at my investment account that I had spent so much time, building up over the past few years, and I was a little disappointed, but I realized I was going to hang on, and I'm not going to sell anything. I'm just going to ride this out. And it's up now. So it's like, you just have to go with it. If you are going to be the person that jumps out at the very bottom, then I don't know what to tell you, but that's not the move there. You just have to let it go through. Now, obviously it's going to depend on where you're at. If you're in your 30s, you got a long time, let it sit. If you're closer to retirement, I'm sure that there's some things you can do and maybe have a little bit more money liquid, so you don't need to touch your investments or whatever. But I think that that is such a good way to kind of explain, you're not losing money if you're just watching it in the stock market go down a little bit until you actually sell it. And then, you've really locked in those losses.
100%. Lauren, to kind of close out this episode, what would you say is your best, from personal experience, the best thing you've done that's helped you grow your investments, that's helped you stay on track with it? What do you feel like is the best thing you've done?
And I'm going to be very honest with you. I have a toddler understanding of investing. I keep everything super simple. So I think for me, after I finished my debt-free journey, I knew, like, I felt a little behind, and I think I sort of am a little behind on my investing. So I knew that was my next goal, is to really ramp that up there. So I think the biggest thing for me is like prioritizing it every single month. I also keep it, like I said, keep it very simple. I don't do anything super sophisticated with my investing. It really just goes into either like a target date fund or an S&P 500, because I'm at an age where I can sort of take the, handle the risk and whatever. But so that's sort of what I do. Like I said, keep it simple, and then also making sure you're planning for it every single month, automating in any type of way. That's sort of how I do it, and how I've, sort of switched my mindset from debt payoff into, okay, now my money is just going more towards investing and, saving for my future.
Yeah, I would say one of my biggest downfalls is paralysis of the analysis. Like if I think too hard, like I can get into a space in my mind where I think too much about something, and it stops me from taking action. And investing is easily one of those things where you can think way too much about it, and you spend so much time thinking that you missed out on like the last year where you could have had huge great gains, or you could have invested when the market was down and now the market's way up, right? I would say for me, the biggest thing that's helped me is just treating my investments like it's just any other bill. Kind of like you had said, the consistency is the number one thing. When I look at my budget, I'm like, all right, I have to pay, we have to pay our mortgage, we have to pay our utilities, we have to have money for groceries, we got to invest into our Roth IRA. Like it's in that conversation of these things just happen automatically. I see it as another bill that just has to get paid. And at first, when you do that, it's going to be hard because in your mind, you don't have to be paying this, right? Yeah. And it might put a little strain on your flexibility inside of your budget. But over time, especially having done that for years now, I don't even see it as something that is optional anymore. Especially when you look at what it could grow to into the future, you need that. You're going to need that if you want to retire on your own.
Yeah.
And so treating it, even if it's $100, that's literally what I started investing on a monthly basis, was $100 a month. And at the time it felt like a huge accomplishment. And now it's like maxing out my Roth IRA every single month, but it's still about treating it just like it's any other bill that you have to pay.
Oh, absolutely. You got to get that muscle working and just, be able to do that, especially as you're increasing your income. Those investments can also increase. Now, I will say, like, we talked a lot about, very basic investing terms today. And I just admitted that I'm literally at the 2-year-old level as far as investing goes, but I'm still going to retire a millionaire because of what I'm doing. You know what I mean? Just very simple approach to investing. You don't need to be day trading. You don't need to be, whatever's out there. Like I said, I'm very simple with it. I'm very lazy in my investing approach. So I think that, you're going to be just fine as long as you actually take action for this. Cause I feel like a lot of people, like you just said, the paralysis analysis or whatever, they just think too much about it. They get scared, and then they go years and years without doing it. They wake up when they're 40 and they're like, how can I, retire? I haven't done anything until this point. So start now. You don't have to be an expert. You're going to get there.
That's exactly right. Couldn't have said it better myself. And you're going to have an easier time the earlier you start. Even if you make mistakes with how you started your investing journey, the sooner you start, the more runway you have, the less actual work you have to put in. If you start in your 40s and 50s, it's going to be really hard to retire a millionaire versus if you're starting in your 20s. Yep. But yeah, I think that kind of wraps it up for me. Lauren, do you have anything else to add?
I don't think so.
Cool. As always, if you enjoyed the episode, if you got a good laugh out of it, you learned something new, the best way you can help us grow is by subscribing and sharing this with a friend.
Yeah, and if you want to have your money question answered on the show, you can visit our website, justanothermoneypodcast.com, and click the submit a question button. And don't forget to join us for another episode of Just Another Money Podcast. The information, opinions, and recommendations provided on this podcast are for entertainment purposes only and do not constitute professional financial advice. Any financial decisions you make based on the content of this podcast are your responsibility. We strongly recommend consulting with a licensed financial advisor or other qualified professional before making any significant financial decisions. By listening to this podcast, you acknowledge that we are not liable for any financial outcomes.